In 1929, the world's biggest financial market collapsed, wiping out fortunes in days. Millions of investors were destroyed, pensions vanished, banks collapsed. But while everyone was losing everything, one man was doing the opposite. He wasn't panicking. He was positioning himself. And when the market finally broke, he became one of the richest traders in history. In the summer of 1929, Jesse Livermore looked completely insane. America was in the middle of one of the greatest economic booms in its history. Stocks had been rising for years, new fortunes appeared almost daily, and Wall Street newspapers celebrated record highs with growing confidence. Bankers predicted even greater prosperity ahead, and ordinary Americans poured money into the market at a pace never seen before. Yet while the country grew more optimistic by the day, Livermore was doing the exact opposite. He was betting against the market. This was not a small hedge or a cautious investment. Livermore was building a massive short position, a trade that would profit if stock prices fell. In simple terms, he was betting that the entire market was overvalued and that sooner or later reality would catch up with it. If prices continued rising, he could lose a fortune. If the boom finally cracked, he could make one. Friends questioned him. Other traders thought he had lost his touch. The longer the market climbed, the worse he looked. But Livermore believed he was seeing something that everyone else was ignoring. And once he saw it, he could not look away. To understand what Livermore saw, you have to understand the mood of America during the late 1920s. The country was intoxicated by success. Factories produced goods at record levels. Consumers bought cars, radios, and household appliances in enormous numbers. Businesses expanded, cities grew, and everywhere people looked, the future seemed brighter than the past. The stock market became the ultimate symbol of that optimism. But somewhere along the way, investing began to change. People stopped buying stocks because they believed in businesses. They started buying stocks because prices kept going up. Teachers bought stocks. Salesmen bought stocks. Taxi drivers bought stocks. People with little knowledge of finance suddenly believed they had discovered an easy path to wealth. The market rewarded almost everyone. Buy a stock, wait a little while, and watch it rise. It felt effortless. Then came the fuel that turned excitement into mania: borrowed money. Investors could purchase stocks with only a small amount of their own cash and borrow the rest. As long as prices rose, the strategy looked brilliant. But hidden beneath the profits was a dangerous reality. The entire system depended on stock prices continuing to rise. If they stopped, the consequences could be severe. Most people ignored that possibility. Livermore did not. Livermore had spent decades studying markets, and he had seen this pattern before. What worried him was not a single event but a combination of warning signs. More investors were borrowing money than ever before. Speculation was replacing analysis. Conversations focused less on company profits and more on stock prices. People were no longer asking whether businesses were worth buying. They were asking how much higher prices could go. To Livermore, that was a dangerous shift. He believed the market had stopped behaving like an investment vehicle and started behaving like a casino. The higher prices climbed, the more people believed they would continue climbing. Every rally attracted new buyers, and every new buyer pushed prices even higher. It became a self-reinforcing cycle. The longer it lasted, the more convincing it appeared. And that was exactly what made it dangerous. But seeing a bubble and profiting from it are two very different things. Livermore faced a problem that every contrarian investor eventually encounters: being right too early feels exactly like being wrong. As 1929 continued, the market kept climbing. Every new high made his position look worse. Traders who had ignored his warnings were making fortunes. Newspapers celebrated the boom. Experts assured the public that prosperity would continue. Some people believed Livermore had become overly cautious. Others thought he had finally lost his instincts. Yet instead of backing away from his trade, he doubled down. He continued increasing his short position because the underlying conditions that worried him were becoming even more extreme. By late 1929, his commitment to the trade had become enormous. Backing out would mean accepting substantial losses and admitting he was wrong. He had effectively reached a point of no return. If the market kept rising, the damage could be devastating. If it collapsed, the payoff would be historic. What kept him in the trade was a simple observation. The market's gains were increasingly driven by speculation rather than fundamentals. People were buying because prices were rising, not because businesses were becoming more valuable. Throughout financial history, that pattern had rarely ended well. Livermore believed he was watching the final stages of a bubble. Then something changed. At first, almost nobody noticed. A few weak trading sessions appeared. Some stocks struggled to reach new highs. Small declines began appearing across the market. Most investors dismissed them as temporary setbacks. After years of easy gains, there was little reason to think anything had fundamentally changed. But beneath the surface, confidence was beginning to crack. And once confidence starts breaking inside a bubble, events can move far faster than anyone expects. The first serious wave of selling did not immediately create panic. Investors had seen pullbacks before and assumed this one would eventually reverse. Many even viewed the decline as an opportunity to buy more shares. But this time the system's hidden weakness suddenly became visible. Investors who had borrowed money received margin calls from brokers demanding additional funds. Many could not pay. To raise cash, they sold stocks. Those sales pushed prices lower, triggering even more margin calls and even more selling. The cycle began feeding itself. The same mechanism that had helped drive prices higher was now accelerating the collapse. Wall Street grew tense. Rumors spread. Confidence weakened. Investors who had spent years rushing into the market now rushed toward the exits. And while panic slowly spread across the financial system, Jesse Livermore watched the exact scenario he had spent months preparing for begin to unfold. Then came Black Tuesday. On October 29, 1929, panic swept through Wall Street. Selling overwhelmed the market. Prices collapsed. Fortunes disappeared. Investors desperately searched for buyers, but many found none. The boom that had made America feel unstoppable suddenly shattered in front of the entire country. The consequences extended far beyond Wall Street. Businesses failed. Banks collapsed. Savings vanished. The crash would become one of the defining events leading into the Great Depression. For millions of Americans, financial security disappeared almost overnight. But while panic spread through the market, Jesse Livermore was experiencing something entirely different. He had spent months building a position designed for exactly this outcome. As stock prices plunged, his short positions surged in value. Every wave of selling made him richer. Every decline increased the size of his gains. While investors across the country watched years of wealth evaporate, Livermore was watching one of the greatest trades in financial history unfold in real time. By the end of the crash, Livermore had reportedly earned roughly $100 million. At the time, it was one of the largest fortunes ever made from a market collapse. Adjusted for inflation, it would be worth billions today. Newspapers turned him into a legend. Some admired him. Others hated him. Many accused him of profiting from national misery. But Livermore had not caused the crash. He had simply recognized the warning signs before the crowd did. While most investors were asking how much higher prices could go, Livermore was asking a different question: what happens if they stop? The 1929 crash destroyed wealth on a scale few Americans had ever imagined. Entire fortunes disappeared. Banks failed. Businesses collapsed. Millions of lives changed forever. Yet the most important lesson is not that Jesse Livermore became rich. It is why he became rich. The signals that worried him were not hidden secrets. Debt was rising. Speculation was spreading. Investors were taking greater risks while paying less attention to fundamentals. The warning signs existed in plain sight. But during a boom, success has a way of making risk feel invisible. The longer prices rise, the more people believe they will continue rising. Optimism becomes certainty. Certainty becomes complacency. Jesse Livermore understood something that many investors eventually learn the hard way. Markets are often most dangerous when they feel safest. That is why he walked away richer while millions were wiped out. He was willing to question a story that almost everyone else accepted. And when reality finally caught up with the market, that decision changed his life forever.
Do you think Jesse Livermore genuinely saw the crash coming before everyone else, or were the warning signs obvious and simply ignored by the crowd? Let me know your thoughts in the comments below.